You're watching the Stock Spy, where we decode market secrets in under 6 minutes. Today's target, Apple Inc. Apple is the most valuable company on Earth, falling behind in the AI war, or just moving in silence. Let's open the file. Apple, the 3 trillion titan. Apple is in nearly every major ETF. Pension funds own it. Institutions stack it. It's more than a stock. It's a signal. A shift in Apple is a shift in the entire market. And yet, in 2024 and now 2025, Apple stock has underperformed the Magnificent Seven. While Nvidia, Meta, and Amazon race forward on AI narratives, Apple's been unusually quiet. Next week's earnings could change that. Apple is set to report earnings tomorrow, Tuesday, May 6th, after the market closes. Here's what analysts expect. Revenue expected is $94.3 billion. Earnings per share, EPS, of $1.52. iPhone sales is expected to decline, particularly in China. Services growth, expected to be a bright spot. But here's the twist. Apple hasn't guided revenue explicitly for over a year, and CEO Tim Cook is under pressure to finally show how Apple plans to lead in the AI-powered tech era. Apple's been notably absent from the AI hype cycle. No AI assistants, no flashy LLMs, no announcements that move the needle, yet. But there are hints in the shadows. The upcoming iOS 18 is rumored to be Apple's most ambitious update ever, heavily AI-powered. Tim Cook has confirmed significant investments in generative AI. Apple is recruiting AI engineers aggressively across the US and Europe. In other words, Apple may be waiting for the reveal. And Wall Street knows it. Here's the real challenge. iPhone growth is stalling. China iPhone sales are reportedly down over 24% year over year in Q1. The Vision Pro, Apple's ultra-premium headset, is exciting, but still niche. In a world where Nvidia is printing growth off AI chips, and Microsoft is reshaping productivity software, Apple's core engine, the iPhone, looks tired. And without a new iPhone supercycle, revenue growth will be hard to justify Apple's lofty valuation. Where Apple shines is services, App Store, iCloud, Apple Music, and especially Apple Pay and subscriptions. Services revenue is expected to grow 10% year over year, pushing toward $25 billion this quarter. Gross margins in services exceed 70%, far better than hardware. Apple is quietly becoming a fintech and entertainment company inside your phone. It's the most underappreciated asset in Apple's empire, and it's why many long-term investors continue to hold. Apple is currently trading around $205, with a forward PE ratio of $128. That's high, especially considering expected revenue growth is in the low single digits. Compare that to Microsoft or Meta, which are showing double-digit growth with similar or even lower multiples. That's why some hedge funds have trimmed their Apple positions. It's not that the company is failing, it's that it's slowing. In a momentum-driven market, that can be a liability. Now, let's see the risks. China slowdown, geopolitical situation, and competitive risks for companies like Huawei. No AI narrative. Lack of clarity may continue to weigh on the stock. And valuation creep, which is overvalued relative to near-term growth. Now, moving on to the strengths. Massive cash flow and buybacks. User base, over 2 billion active devices, and Apple's world-class ecosystem, services, hardware, payments, and health. So what should the viewers do? Should you own Apple ahead of earnings? Here's the Stock Spy's take. Apple is not an AI growth stock, at least not yet. But it could become one this year if it executes on AI in iOS 18 and new hardware. The services growth and brand loyalty remain unmatched. We rate Apple a hold, with a confidence score of 55% for 12-month upside. Short term, expect volatility. Long term, still a foundational bet, but with conditions that could change in the coming months. That was today's Intel Drop. Thanks for joining Stock Spy, your 5-minute briefing to financial freedom. Subscribe to the Stock Spy for our Palantir earnings breakdown next, and a surprise AI underdog we're tracking for massive upside.